All right, so we had a little bit of an up and down day, mainly a down day for some areas of the market, and an up day for some other kind of surprising areas of the market. So, some really interesting, like if you look at different relationships, it was kind of a risk off day, but markets didn't really go down very much except for, like I said, a very specific area in the market. So, we're going to take a look at how Netflix and Facebook and a bunch of other stocks in that sector, as well as another niche area in the market that's been well publicized lately, just got hammered today. So we're going to see kind of what ramification that has and can have, more broadly speaking, when you go across the whole level, the whole broad market level. We're also going to take a look at other assets that are making moves. A big move in the dollar today will break down. Big move in bonds today will break down. As well as our trade idea of the day is a stock that kind of broke out yesterday above a bunch of moving averages and is giving us, a pretty decent and pretty rare, but pretty decent breakout bullish opportunity. So let's go ahead and get started. Today is Wednesday, April the 20th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator here. You can see it's trying to climb back up above this 38% retracement level. That was the area we broke for support and started this kind of intermediate decline-ish. Got the intermediate line out of bullish territory, did not get into bearish territory like the Russells did. As you can see, near-term line finally ending this near-term decline, right? This was a big, long near-term decline. You typically get big, long, near-term rallies like this when you're on bullish moves, but you typically don't get big, long, near-term declines while you're on bullish moves. So now that puts a lot of pressure on this near-term run to be big and long too, right? Get up to a new high because right here is the last near-term peak. So that's the pressure, and it's above 80. Like if it peaks here and comes right back down the next day or two, then that would be a really bearish near-term peak. Obviously, it would be a lower one, and we really need to kind of this 23% retracement level here. Remember, retracements begin when you break the 23% line. They end when you get back either above it or down below the 78. Right, so we'd have to get back above it, and then also you can see this long-term decline that we've been on. That brought the market sentiment line down. That's why I've got them orange. This line's orange. There's also that last resistance level there that would really, that's kind of at 45.50. So between 45.25 and 45.50, if we can get through that area and above it, then we have a really good chance of pretty decent bullish move going. But if we hold resistance here at the 50% retracement of that long-term decline and the 38% line of this little intermediate run that we had been on, then of course that's why it would be bearish, right? So that's kind of what's going on in the market forecast with the S&P. So right now, dark green shading a green line, but and a bullish near-term line, getting in the upper reversal zone, not quite getting up above that 90th percentile where you're really feeling strongly bullish about things, right? That's where you feel a lot better. Not quite getting there, and we're only a day. So let's see if we follow through with this with some good bullishness tomorrow. I don't expect that we will. I expect actually that we're in this bearish move here because again, you don't get these kind of near-term declines on bullish trends. That's the problem. That was a very long near-term decline. So we really need to break. This basically was an intermediate pullback. It just wasn't very long, right? This wasn't a very long run. But considering how long the near-term decline was, this basically was an intermediate pullback, and technically we would be starting a new intermediate rally here. A new intermediate run. So you really need to get a good solid near-term breakout, and today wasn't that day, especially considering it's actually a down day today. We were down almost 3 points there. When you look at the NASDAQ 100, you'll see that it was just not a good day. Of course, we know why, Netflix and other things, but it was just not a good day today in that sector, in that communication sector. You can see the near-term decline has been on, very similar to the S&Ps. It did get the near-term we did look really good here, that we might, avoid a pullback and just keep going. But the problem was, again, that's when you get up in the bullish territory, but you don't get strongly into the upper reversal zone, that's not a bullish move. And so that's kind of, again, we're in bullish territory. We're not in the upper reversal zone. We're not in that 90th percentile higher either. So So not, not the best by itself, and we're still 2% below the moving average. So by itself today, boy, it does not look like we are headed back to the upside. The Russell 2000 is a little different, but because it's above the moving average, and it's a little different because it actually did pull back below the 38% and the 62% and the 23% retracement line of this decline. So we had come back down. Today or yesterday, we got slightly above it, and today we tried to follow through on that, but not really a significant breakout. The near-term line did get here, but not, again, strong bullish levels. So again, in long upper shadow, this would not be a good bullish peak, right? This would be a very bearish peak if this is the peak. So, and I'm leaning in that direction. I'm leaning in that direction of this being a bearish near-term peak. But for it not to be, we have to have that near-term line really really follow through, get back above this 38% retracement, 2060, and then eventually get back above that 2338 combo here, where these lines are lining up on top of each other, and to really get going to the upside for the Russell. So we are not there. Very, very weak bounce to the upside here, and you see that as well in this crossover chart. You did get a green arrow today, so we're back above the 40-week, but it's a bearish candle. It's a negative Hakunashi differential, and the PPO is still falling. So you don't have the three things that you need to see on that chart, and you're not getting any of the three on. You do have a rising PPO, so you're kind of getting one of the three there on the Russell, and then the NASDAQ 100, we're not getting any of the three, right? Negative differential. It's a pretty bearish candle, no upper shadow, falling PPO, and no green arrow, right? We're still red. So even from that perspective, not really looking good. From a three red arrow standpoint, at least we don't have three red arrows anymore in the S&P. So we kind of stopped the light pink shading. We did not stop it on the Qs. There's still got light pink shading there. We stopped it on IWM. We got three green arrows. So we actually got green shading on IWM. So now here's the kicker, right? We got to follow through with this with another day, another 2-3 more days of green shading. Like right now, you see we're getting green shading on the Dow Jones Industrial Average too. So we never did get the pink shading on the Dow. So we need to really follow this up and have a good run of green shading if we're going to be bullish. If you only get a day or maybe two, at most three, not enough. So again, I'm leaning in that camp towards we're only going to get one or two here, but I will be wrong and change my expectations if we can continue, right? If we can get up to 3 and 4 in a row, right? Because that's where we really feel good about, especially if we're getting above those levels I pointed out to you before. Here's the other factor too in terms of today's bullishness. You see we are still just in the gap. We are above the 30 and the 50. We are back above the 17-day just barely. So we really need to hold that and get above the 200-day. We're just barely above the 17-day. The Qs obviously are not above the 17-day. In fact, they got back down below the 8 days. So we held resistance at the 30. We held resistance at 17. The MACD is still below its moving average. It's still negative. So the SPY, the MACD is still below its moving average and still -2 and just barely above the 17. So we need to follow through with this. And then IWM, again, it did get above the 17 yesterday. It tried to really solidify that today. The 50s here too, right? So it would start to, basically, if we took off from here, we'd fill in this gap up to at least up to the 200. The MACD is above its moving average. It's still negative. The stochastics and its moving average still in bearish territory. So you're getting signs, right? We're getting signs, but not the signs themselves are not strong enough to be even like, whoa, like there's a really good chance we're turning bullish. It's just like very, very weak bullish signs. You can see the DMI, the positive indicator is nowhere near above 25, even if the negative is below 25, and that's why it seems that, at least we're not bearish. Same thing here. The NASDAQ, the negative got below 25, but the positive is not even above 20, much less above 25. And IWM, again, it's a great bullish move here, but again, did not get above 25. So that's what we need to see, at least get above 25. And again, the ideal is to get above 30 with the negative below 20 to get the ADX to go higher, to get a good trend started. And obviously we don't have that. The RSI and the CCI are in neutral levels, very, very neutral levels for the S&P. Lower end of neutral levels for the NASDAQ. And then again, very neutral levels for the Russell. So these are not bullish signs at all. It's a problem. Looking at the Bollinger Bands. Oh, we didn't look at the Ichimoku Cloud. So let's look at the Ichimoku Cloud. Trying to get up above the cloud in the S&P, didn't quite make it. No trend going at the bottom there. IWM, again, we got above the blue line, but we're still smack dab in the middle of the cloud, so it really doesn't matter what it does here. As long as it gets above the cloud over here in this area, that's the ideal. But again, no trend going on down there. And then you look at the Qs, and you can see eventually, whoops, I got 4 Qs in there. You can see that nowhere near getting out of the cloud and no trend going on there. And when you look at the Bollinger Bands for the Qs, you can see we are not in the lower quartile, but you're in the lower half of the Bollinger Bandwidth. SPY is actually slightly in the upper half, right? But again, this slightly, we're not really solid breakout here either, and that bandwidth is still pretty high. It's going to be hard to get it, and same thing here. So we're going to be hard to get a breakout when the bandwidth is already relatively high. It's better when it gets down to closer to this dotted line when you get that breakout. And you can see just barely in the upper half, and hardly like really breaking up into above that 60th percentile or higher. So that's kind of what we're seeing, like very, very neutral candles. The volatility is still really low. So we haven't had that volatility flush to the upside, right? That says, oh man, we've been so bearish here. That volatility is flushed up here above 105%. And you notice, like, you go back to other times that are similar to this, where we've had these correction type spikes in volatility. This one in 2011, 15, right there at the beginning of the 15-16 drop. The fourth quarter of 2018, obviously the COVID drop. You look at this compared to 1, 2, 3, 4, and you can see this is nowhere near what we're seeing. Even if we're in the 20s, right, you can see we got up to about the low 30s in the fourth quarter of 2018. In 15, we got up to about the high 20s. In 2011, we actually got up into the 40s. But compared to these other two, we're actually kind of more strongly bearish. The VIX is higher, but on a relative basis, the VIX, what that means is the VIX 3M is still higher. And when you compare that all as well with the skew, if you look at the skew chart here, let me update the skew. You can see it's still, it's not the highest, but it's still relatively high and dropping, right? So you can see the average, we're below the average, and the average is dropping, and that typically happens when these roll over when you're bearish, right? And when you're bearish, that's when the skew gets down here and we're rolling over, and you can see it's just starting to roll over. We picked up some volatility over here when it rolled over, and we got bearish over here when we got below the average and it rolled over. So it looks like we might be doing that again right now. So hardly the flush, right? The flush to the upside. We're still above 20. We're still in the 85% mark. If you look at it on this basis, when you look at the VIX here, you're still kind of around that 200-day moving average. The MACD is still below zero, or still above its moving average, even if it's still below zero. And stochastics, the average is still in that bullish territory. So it's not quite like broken down. If it breaks down below 20 and breaks down below these levels, then we'll know. And especially when you see, when you have like the range and the volume here, the 65 million, the range at 4 points, a 4-point range, that's really low. 4-point range here we go. 4-point range is below 1%, right? And so that would be down in here on the relative basis. But the problem with that is we're still below moving averages, right? When you're below moving averages, you need like a 2% rally to really break you up to the upside. This wasn't a 2% rally. This, like a 2% drop, starts you on the bearishness. A 2% rally gets you going. And we haven't had really either one of them lately. We've had this one, and that kind of stalled the bullishness, and now we're stuck on that. But the Qs, you can see the Qs have had 2% drops in a 2% rally, and we're still kind of stuck in volatility mode. So it's not that little 4-point move and 65 million shares trading hands is not the kind of move you like to see right now, right? We'd like to see it really be bullish, kind of like here, really be bullish. Follow up some more candles like that one, like we had yesterday and follow through with that. And obviously we didn't get that today, and volume really light. So it's the average volume is already really low. And again, we're still below these moving averages for it to be able to get for it to really kind of take off again. So so my expectation again is that we're on a near term jump right now, and it's just going to be nothing really more than that. Maybe a day or two of the near term line staying up here, but then we'll probably stick on this little decline that we've started since that peak on March the 29th, right? We'll stay on this little decline and retest these lows, if not go lower, and actually again start the correction move that the S&P really hasn't, right? When you look at the S&P on this long term, it still hasn't corrected like the Russell 2000 has, which is easily below its 50-day moving average, and still below the 50-week moving average, and still below the 17-week. The Qs, you can see, same thing. We're easily below the 50. We have been for a while, and we're still below the 17. So SPY is barely above the 50 and barely above the 17. So we've hardly extended and broken that 23% retracement and really started a correction. And I don't think we'll be done until it does, right? Until it actually does start the correction and then works its way through to wherever the 200-week moving average will be at the time. So do you agree with that? You disagree? Let me know in the comment section. In reply to the Market Outlook tweet that I got pinned to my Twitter profile, today's Market Outlook tweet, reply to that tweet with whatever charts you're looking at. Maybe somebody shared something on Twitter, or maybe you're looking at something there on your screen that's kind of giving you an idea of why you either agree with my assessment or you disagree with it. Reply to that tweet and let's take a look at it and be able to share with other people what you've got in mind. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked the video today, and you want us to do another video again tomorrow. It's a quick way to let us know you like our stuff. Of course, if you don't like it, you don't have to click on anything. Also, comment down there. What did you get out of the videos today? What questions or comments do you have? What stood out to you? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle, @DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things on the right, including the Market Outlook live video. Here's where I do, if you click on that, it takes you to this page. On Monday, Wednesday, and Fridays at 3:30 Eastern Time, I do a quick 10-minute, 15-minute video. I take a look at the trades that we're already in from other Market Outlook videos. In fact, we closed a couple today in here, and we also put on today's trade idea already before the market closed. So that's where we did that as well. You can see all the archives down here. You can also get to it by clicking on Market Live Trade Review, Market Outlook Live Trade Review right there. Come down here, you can see our upcoming classes. Click on View More. You can see our full calendar with all our recordings that go back 4 years, as well as our upcoming classes there. If you come down here to the bottom, hit that heart. It opens up a new tab. Hit the like button. You can do it right now while you're watching. Same thing with the Facebook icon. Click on that thumbs up. Come over here, hit that thumbs up icon. Again, the more you do that, it helps get our content out to all of our followers on these accounts. That's why we always ask you for it. So we try to make it really easy for you too to do it right here while you're watching. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it easy for you to engage with us here. All right, now let's take a look at what's driving the price action today. And you can see it's not really a risk-on day. In fact, the bonds were the biggest performers today. Real estate was the second biggest performer. And you can see gold was the fourth with developed markets, which have been pretty oversold, bouncing up there. But that's not, again, exactly your biggest risk-on moves, say risk appetite trades. In fact, they're at the bottom. The Qs and EEM are your kind of more associated with risk appetite. And you can see the dollar also had a pretty significant move to the downside, and that did not help EEM. But keep in mind, too, that dollar move here, if I take a look, 1 second here. Let's take a look at the dollar move. I compared, remember, because the dollar index is a basket of currencies. That's the dollar against the euro. In fact, let's get it on this chart. Coming off of a cluster, if you saw it, if you barely saw there before I changed it. But we are basically still way below moving averages and just barely at the 8 day moving average MACDs on this current period that just started tonight. is crossing, but still below the 17 days, so hardly bullish at all. That's the biggest, by far the biggest component. Makes about 57% of the index. Another 13%. So between these two currencies, it makes up 70% of the index is the yen, and that's what the yen did. So I mean, there's hardly a bullish move or bearish move on the dollar. It's a one down day, but not very significant. You can see basically came down to the 8-day moving average today, and nothing really more than that. So that's the issue, right? And then you can look at it here too on a currency comparison, and just look at today and see the same thing. This with these same charts. Keep it at 5 minutes. So there's the dollar. There's the the Canadian dollar is actually up the most, and that's the biggest component in the trade weighted dollar index. And then there's Japanese yen, your euro, your next two biggest ones. 70% of the the futures contract, the dollars index. And you can see down here, South African rand, Norwegian krona, Mexican peso, all commodity related. Same thing with the Australian dollar and the New Zealand dollar, all commodity related currencies that are not as bullish. So you see that the dollar really wasn't that bearish. It was these currencies, especially the Canadian dollar, that really took off. Let's take a look at the U.S. dollar against the Canadian dollar. And that kind of gives us a little bit better idea of how bearish the dollar is. It is below a 200-day moving average, and that was a big drop. So there might be some more weakness to the actual dollar itself coming forward here. Very sideways move after being, you can see after this big decline in the dollar coming out of COVID, we rallied back up and are now, and tried to get back, we broke the 200-day, we tried to get back above it, and so far it's failed, and it looks like we might be below the 200, so we might be in a bearish zone. But unlike this period, which is actually bullish for risk appetite, remember the dollar's been associated, dollar strength has been associated with the bullishness since that period. So now dollar weakness is actually going to be more risk off than it is risk on. As I said, the euro and the yen are the ones that are really, really oversold, right? I mean, look at the euro versus the Canadian dollar. You can't really, let me get rid of that. I mean, look how oversold the euro is against the Canadian dollar. Look at the yen against the Canadian dollar. Look how oversold the yen is. It's just so extremely oversold. So again, these are safety trades now. Especially the yen's always been a safety trade, and so if the dollar starts to drop, it's because these safety trades are starting to rise. The yen and the euro, right? The euro being quasi, because of its value and margin of safety, more considered a safety trade than the U.S. dollar is at this point. So again, so it wouldn't be, like I said, back over here from this period where the dollar rallied during that period. Well, you can see so did the Canadian dollar against the yen. So safety was down, and same thing the euro CAD during that same period here. The euro dropped during this period of 2021 when the dollar was associated with bullishness. The euro was dropping there, so the dollar was really rallying because 70% of its components was dropping pretty sharply against everybody. So yeah, that's kind of what we talked about before. You have to take that dollar strength with a grain of salt. It's not really the dollar that's been so bullish. It's been more the components in that index that has been more bullish, or bearish, excuse me. And if they bounce, this time the dollar weakness would not be bullish like it has been. It would actually be more bearish as these other areas bounce up higher. So that's the currency market. If you look at how the sectors have performed today, you'll see. I mean, obviously you can see what's driving the price action from an equity standpoint today is that big drop in XLC down 4%, XLY down 1.25%, XLK was flat with the market, and then you have real estate, utilities, staples, and healthcare. Your four biggest winners, all between 0.75% and 2%. Those aren't bull market leaders, right? So the fact that they're so bullish is mainly because these were so bearish, right? And people move their money out into something else. Big decline, really big decline in XLC. In fact, if you look here, we did this in class today. If you look at the S&P 500 here, you can see there's a lot of green at the top of the S&P. The red is coming from a little bit from Apple, but Amazon XLY, Alphabet XLC, Nvidia is XLK, Facebook XLC, and then a lot of green in Berkshire and Walmart, and Procter & Gamble, JP Morgan, Exxon, Visa, Chevron, Home Depot, Coca-Cola, and then you're get a couple healthcare stocks in there not doing so hot, but look at Walt Disney, XLC, Comcast, XLC, Adobe is in XLK, Salesforce in XLK. A lot of these internet companies not doing so well. In fact, look at this. When I show you the weeklies, the stocks that are in the weeklies, look at where the biggest losses were. I mean, you'll find Netflix and Shopify and Roblox and Peloton, Spotify, Twilio, Match, Fastly, Carvana, DocuSign, Block, Wayfair. These are all these internet companies, right? Snap, PayPal, that have all been doing so well. There's Facebook there, Pinterest, Robinhood, Tilray, AMC. They had all been doing so well. Virgin Galactic's been doing so well, but not today. And you see that basically what we saw today was these stocks breaking down again. So they tried to get going, and it way more than offset that rally, down 6% today to new lows, down below the 78% retracement. Let me show you where that 78% retracement is coming from. There's the post-COVID rally, breaking below that. Very little support down here. If it were to keep going down here, I mean, that's just, like I said, very, very little support. Even on a 5-year basis, you can see with all that price movement, very little volume down here compared to what you have above it, right? Above it, there's a lot more volume here in this area than there is in any of this. And there's multiple years worth here. So that there's no support for ARK right now that is breaking down below this very long-term 78% retracement level. This is the high end of risk appetite scale. So if this goes down, if Bitcoin follows suit, right, then we know that the high end of the risk appetite scale, and you can see Bitcoin's been trying, it's been below at 17, back below the 50, consolidating this loss. If it makes a new leg lower to the downside, then because it's already below the 200-day moving average there, and it's just starting to, like I said, it's just starting to correct. ARK is already in the bear market, but Bitcoin is just starting to correct. If it gets down below this 50% level, makes its way down here, no volume, then again, high-end risk appetite scale. So that means the market is going to be shifting more towards safety again and getting out, making another leg lower. There's that initial leg lower in this scale, on this side of the scale, and we've been consolidating. So you'd expect out of a consolidation pattern, especially this kind of flag pattern, that we'll have this same kind of move to the downside coming out of it here. All right, so despite a pretty gloomy macro technical picture, that doesn't mean we can't make bullish trades. And that's even today's trade idea is going to be on that bullish side. Now, remember, the Market Outlook Live, we've already done this trade today. We did it before the market closed, and we also closed a couple of recent trades. So check out the Market Outlook Live to see what we did and why we did that. So HOG, we rallied here today. You can see all these moving average converging, 50, 200, 30, 8, 17, all sitting right on top of each other. And then yesterday, we had this kind of triangle here. We broke out of that yesterday. MACD got positive. Stochastics got into bullish territory. You got above this kind of volume that's towards the top of that big, strong volume node. You're still in the value area, so we're not that bullish, but that's a pretty good bullish breakout move. When you look at the 3 green arrow chart for HOG, obviously you got 3 green arrows here, and now you have for a second, it looks like you probably will have for a few days on that, unless we really turn sharply lower relatively quickly. When you look at the, I should show you the market forecast chart. You're breaking up above the market sentiment line. You're breaking above into bullish territory. You got a relatively strong near-term line. You're 6.5% above the 30-day moving average. Very strong move. When you look at the directional movement index, the positive index did get above 25. In fact, it got above 30. The negative got below 20, so that leads to a rising ADX, which is really, really low. We've been in such a very sideways trend for so long, so noisy for so long. We haven't had a strong trend for almost a year, right? It's been, well, we had this bearish trend. We had strong bearish trend here. But since for about the past 6 months, we haven't had any kind of trend going. And so we'll see if this turns out to be a breakout move. You can see the Bollinger Bands. We actually got above the upper Bollinger Band earlier today. We finished just barely below it. If you take a look at the Keltner channels, here, this down here at the bottom. Take a look at the Keltner channels, you can see we are almost outside of the Keltner channel too. So we were really close to getting a green dot with a close outside, and we just didn't finish at those highs. But you can see the bulls are there, right? So they were there during the day today. So there's an opportunity we can get that there tomorrow. When you look at the RSI and the CCI, you can see getting above 60 is a great sign. Getting above 200 is a great sign. So pretty decent bullish pattern here. Looking at the long-term chart, the Hakinyashi candle, green arrow, rising PPO, positive differential. Good sign from that perspective. We didn't take a look at the hull. That's something that we look at here occasionally. You can see we're green. We got bullish candles that are closing. The Hakinyashi closes above all these highs. So very good bullish Hakinyashi close, and the parabolic SAR down there at the bottom. So really good move. I need to move this, get this over towards that 200. There we go. And you can see we are above the 200-day. You know, the stock is above the 200-day. It's above the moving average. So there's an opportunity to be pretty bullish here. The 200-day hull is already green, and now we're turning green here. And like I said, good opportunity. I just wonder how bullish we can be considering the macro picture. So as long as we stay bullish with that really good support, I don't think I highlighted that really strong support that we have below us right here at the, here's right below where we're at pretty much yesterday. Very strong volume node down here at the bottom. So I don't know how bullish we can be directionally without the broader market being really strongly bullish too. But at least we know that we're bullish enough to maybe stay up. And we got very strong support below us. So that's a good bull put spread opportunity. So that means we sell the 39, buy the 37. That puts me into this picture here. And then position size up to a full contract size. And then that break even is going to be at that very strong support level. And from a intraday standpoint, you can see for us to get back down here, we'd have to break back. We'd have to basically nullify this breakout and get back below the point of control in the 4-week chart too, for us to get enough of a loss, which would be $350, which is what I'm willing to take to close out this trade early. So that's our trade idea for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out on the top left corner of your screen. That takes you to our Market Outlook forums. Open up any threads there with any questions or comments you have, or apply to anybody else's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, comment on the video. Remember, you can also subscribe to our website for free at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.